Hi, my name is Richard Brown from Abound Paraplanning. Welcome to today's video. Today's video is on the main residence and capital gains tax. Now we know that there's no tax on our main residence, but the waters certainly get murky when we move in and out of our main residence or we buy another property that we would like to label our main residence. Now at the outset I would like to say these rules can be quite complex and each and every person's situation is different. So we encourage you, implore you to seek professional advice if one of your clients has any of these situations to confirm that you're giving the right advice to the client based on their personal circumstances. So I have to say today it's not advice, it's just general commentary around tax and the main residence exemption. Now, the first point that we should be aware of, and to be quite honest, I wasn't aware of this either, is that all assets are subject to capital gains tax post 20 September 1985. We knew that, but that includes the main residence, but there is a specific carve-out for the main residence. So you could say that pretty much all assets are in, but there's a carve-out for the main residence. Now, as I go through this video, I'd like to share a few examples with you that may relate to a client situation in the future, but the main focus of the video is just to make you aware of some of the issues around the main residence and potential capital gains tax. Now, the first and most obvious is that if I live in my main residence and I move out of my main residence to another location, say interstate because of work, and I purchase another property in that state, what happens, which is my main residence? For instance, I move from Melbourne to Canberra, I purchase a property in Canberra, and I keep my Melbourne-based property, which is my main residence. Well, that's going to be entirely up to yourself. But you can only nominate one main residence at any one time. Now, there is a rule known as the 6-year rule, where you can move out of your main residence into another property, purchase another property, as long as you're not referring to that as your main residence. You can maintain your property, say Melbourne to Canberra. You can maintain the Melbourne property as your principal residence for a period of up to 6 years. This was often known as the politician's rule because often people had to move to Canberra, move away from the family home, and they would acquire a unit or a place of residence in Canberra, so they were able to maintain the main residence for their property in Melbourne. Now, I've got to be really, really clear here that these rules that I'm discussing today only apply if the property in question was your main residence immediately before you started to rent that property out. If you brought an investment property and then move into it, the rules are completely different. Now, so I've briefly spoken about the 6-year rule. That is where you move out to another interstate location. You've got a time frame of 6 years. You can in fact have a time frame of greater than 6 years where you move back into the property as your main residence. Then you may at some future stage move away again. You can restart that clock. So in fact, if you've got one main residence for your family, you could maintain this for 2 or 3 periods, if you like, of 5 years, and you could still maintain that property as your main residence. If you acquire another property in another state and subsequently sell that property in another state, you must include the capital gain on that property in your tax return to maintain the former residence as your main residence, because you can't have 2 at the one time. So whenever you sell a second property, that will determine which property has been nominated as your main residence. So the 6-year rule, very important one. Now, if you have a main residence and you move into state, as I've said before, and you don't rent the former main residence, which is your original place of residence, you don't rent it, i.e. a family member is living in the property, well, you can in fact maintain it as your main residence indefinitely. Once again, be aware that if you purchase another property, you can only ever have one as your main residence. Okay? So I hope we've got that point down pat. The next point I would like to share with you, what happens if we breach the 6-year rule? So, got a property in Melbourne, we moved to Canberra, where we've lived in this property. I'll use an example. We purchased a property in 2000, it's now 2012. We lived in the property for 4 years as our main residence first. Then we moved to Canberra for the next 8 years. So we've breached the 6-year rule where they've been there 8 years. Then we subsequently sold the property in 2012 and we elect that that property was our main residence. Well, using that example, 2/12 of your total gain, you've held the property for 12 years, 2/12 would be subject to capital gains tax. But be aware that it's done on an exact days basis calculation. I'm just simplifying it. 2/12 would be subject to capital gains tax. As you've held the property for more than 12 months, you would get an additional 50% reduction in the capital gain because you've held the asset for more than 12 months. Hope that's a nice tip for you as well and makes sense. Now, the next example I'd like to share with you is using the same sort of facts from the previous examples. I live in Melbourne, I've got a property in Melbourne, I moved to Canberra, I'm a politician, and I purchased a property there. I decide in this particular case to nominate the Canberra property as my main residence. What happens to the Melbourne property? Well, the Melbourne property then becomes an investment property. But one important rule that's listed in the income tax legislation is that if you don't apply the 6-year rule that I've spoken to you before, you can apply what's called the 20th of August 1996 rule. And that means, using the example that I've given you before, is that in 2000 I purchased the Melbourne property. I didn't move out till 2004 and moved up to Canberra at that stage. What I should do is it allows you to get a market value uplift in 2004 of the property that you purchased in 2000. Now that could be a significant lift in the cost base of the property for the purposes of capital gains. So what I would advise you to advise your clients is that in all cases where they are moving out, because we're not quite sure whether we'll use it as our main residence or we'll use it as an investment property in the future, and that will be based on, look back, because we'll see what the gains are in the Melbourne property versus gains in the Canberra property or wherever you go to decide which is going to be your main residence in the future. That being the case, advise everyone to get a market value of the property on the day immediately before they walk out the door and make it rentable. Therefore, you've always got a document that you can refer back to for capital gains tax purposes to show the ATO, if required, that you did get a proper valuation at that point. The final example I'm going to share with you, and you may get a lot of these questions from time to time from clients or friends of clients or at the Sunday barbecue. They can be quite straightforward to answer, but sometimes the off-the-cuff answer is not the correct one. So I'm just going to give you a few pointers on this particular issue. Have a client that has got a property, a rather rundown property in a prime location. The client decides that they want to demolish the property and build 2 townhouses on that existing property. What are the capital gains tax implications, if any? That's a fairly common question that gets asked. Now for the example. Now on the basis of what we've discussed already, let's use the same example of a property purchased in 2000. It's a main residence. The property was purchased for $500,000 and the client wants to demolish the property now and build the 2 townhouses, each costing $400,000 each. Now for the assumptions here, we're going to assume that the property split absolutely 50-50 evenly. Now, the first point that you should be aware of, that a lot of people aren't aware of, is that a value needs to be put to the actual structure of the property. So if it was $500,000 purchased for, we need to make an assessment of what the building value of that is, even if it's run down. Now, to simplify the example, we've put $100,000 on the value of the actual structure, so that comes down. So we're left with a reduced cost base of $400,000. That would then be split evenly amongst the two properties, $200,000 for each property. Now, if the bill, as I said, was $400,000 each, we're left with $600,000 as a cost for each of the structures. Now, let's deal with the property that we intend at some point to sell, and that's critical. What is our intention at the outset? Are we intending to sell it straight away to reduce the mortgage on the main residence, or are we going to use it for investment property? Just points to be aware of. If we sell the property within the first 12 months, there is no question we're going to be assessed on, and say we sold it for $1 million, we're going to be assessed on the full $400,000 gain. Full $400,000 gain. Now, furthermore, is that we might find ourselves into the GST, Goods and Services Tax regime as well, because our intention is profit-making, undertaking business to maximise our gain. So you've got to be very, very careful with that. If that's the way you want to go, that's fine, but just be aware of it. If your intention is, listen, I'll rent the property out for a few years at least, or long term, I want to put the property on capital account, what we do in those situations is we need to keep the property for a period of time. I'm not going to tell you exactly how long that is, because it's different and it depends on your intention, but let's say we kept the property for 3 years as a rental and then we decided to sell it. Well, the capital gain, and just assume that the property market hadn't moved, we sell it for $1 million, we've got a gain of 400, we get a 50% discount, we're taxed on 200,000, not 400,000. And then we pay tax accordingly. So that's how that property piece would work. In terms of our own main residence, this is the tricky part of the legislation, and once again, seek advice, is that the future capital gains tax exemption as our main residence only extends, once we've demolished the property, to the property that sits immediately underneath the home. So it's the land and the home going together in exactly the same proportion. So technically speaking, we could have the surrounding area, grassed areas, or the backyard could be even subject to capital gains. Once again, seek advice when the time's appropriate. One final point in relation to the townhouse tax implications is that correct planning at the outset, depending on individual circumstances, may in fact, this whole scenario and the large capital gains may in fact be avoided if some correct planning is put in place. That's why I say seek some advice. If that transaction is done purely on the basis of what I've just told you, that's general advice, but that's the way that it would be treated. The final point I'd like to make here is that a lot of these examples that I've spoken about today rely on the main residence being your main residence immediately before you move out. You can see how the water can get a bit muddled and grey once we move out, or we knock it down, or we do this or do that. So that's the opportunities for advice to be providing to your client or through your associations with an accounting or tax advisor. One final point, that if you use the property as an investment in the first instance, then moving to your main residence, all of what I said doesn't apply. If you subsequently sold that property, i.e. you've used it as investment property for 5 years and you move into the property for 5 years, then 50%, 50% of, and once again days calculation, is subject to capital gains tax. That's very simple. None of those rules apply, and you'll be entitled to a 50% discount because you've held the property for more than 12 months. I'm glad that you've joined us today, and I appreciate the emails that you send me regarding some of the topics. I've tried to make this one pretty interesting because it's something that comes up regularly, and yet when you talk to people about it, there's all different sorts of opinions and answers. So I've given you some pretty accurate general advice there. All right, so I hope you find it worthwhile. My name is Richard Brown from Abound Paraplanning. Hope you've enjoyed it, and I'll catch up with you soon. Bye for now.